Hey, happy Wednesday to everybody. Time for managing an options portfolio. My name is Brent Moores, and I'm glad to be with you today. And I want to go through and talk about selecting an option strategy today. I want to talk to you about managing various options positions today, which we normally do in this webcast. So we're trying to get you more adept with options, understanding them, pros and cons, how to manage. That's the goal. But I'm glad to see you out here today. I appreciate you. I'm joined by Kevin Horner in the chat. Appreciate Kevin. And I was on with Kevin earlier today, in fact, on Trader Talks. He does that on Mondays, Wednesdays, Thursdays, and Fridays. It's a great way to kick off your morning, by the way, if you are interested in the markets. That occurs at 9:30 Eastern Time. But we've got managing options portfolio. You can follow Kevin or myself on X at Brent Moore CS, at Kevin Horner CS for additional financial content throughout the week. And before we get too far into this, though, let me just mention a few important things that you need to know. One, options do carry a high level of risk and are not suitable for all investors. That's why education is important. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And what we're going to go through today is for general informational and educational purposes only. Paper money software application, which is what we will be using, is provided for educational uh, purposes only. And I recommend paper money. Trying out some of these strategies here on this. Schwab does not recommend the use of technical analysis as a sole means of investment research. All investing involves risk, including loss of principal. Past performance is no guarantee of future, results. Okay. All right. Let me go. Let's head on over to the Thinkorswim platform here for just a sec. And I want to talk about um, your option strategies. And you likely have a portfolio that you're looking at. And with your portfolio, you have various option strategies and you have option Greeks with each of these. And as you're deciding whether you're doing new trades or managing existing trades, there are some considerations that I want you to think about as you do so. Delta, theta, vega. Remember, delta tells you the direction that the directional exposure of that options trade. Okay, positive deltas means it's a bullish trade. You want the underlying stock to go up. Theta tells you the time element of the options trade. Is time working in your favor if theta is positive, or is it working against you? Theta is negative. Vega tells us the implied volatility exposure of your trade. Does an increase in implied volatility help your trade or hurt your trade? Typically on these, typically, not always, but you're going to find that delta direction is the biggest factor that impacts the trade. And so very often we look at these and we go, well, I'm bullish and therefore I'm going to do such and such a trade. But sometimes we forget some of these other elements here. And I think those are important to consider. But let's talk about some various option strategies and the Greeks' exposure to these. And so when you may consider doing these various strategies, or if you actually have those in your portfolio, what's the impact if you remove some of those strategies? They will affect your overall portfolio because it's not just an individual trade by trade thing we're doing. We need to be mindful of the overall portfolio. So for example, if I consider long calls, they're a positive delta trade, right? In fact, I could even do this. I could say they're very positive delta typically. I mean, it depends on the strike you pick, but that's how they go. So positive delta trade. All right. Long puts, they're negative delta. Okay, they're they're directionally negative. Okay, so those are kind of two clear things to look at. Short calls, negative delta. Short puts, positive delta. And all option trades are basically a combination. Doesn't matter what kind of strategy you're doing, what kind of spread you're doing. It's these four elements here. You could think of these as Legos, four types of Legos that you can build a whole bunch of different creations from. You could think of it as DNA, thinking of mRNA today and the move they've had. Think of DNA. You got four nucleotides, nucleic acid types that you're dealing with that make up your DNA. And it's just the sequence of these. Same thing here with calls in the sense that we have these building blocks that can build up a whole bunch of other trades. Now, with long calls and long puts, time decay is working against you. With short calls and short puts, time decay is working for you. And on these single options, one way to remember it is your theta and vega are going to be opposite directions on those. Vega is positive when theta is negative. That's just for, that's just for these single option trades. That doesn't hold for all option trades there, okay? And so short calls, negative vega. That means if implied volatility goes up, it works against you. Short puts, negative vega. So this is, hopefully this isn't brand new information to you, but maybe a good review. It gets more murky here when you start adding in spread trades, vertical spreads. Now, you'll notice next to short put vertical, I have OTM next to it, out of the money. That's how typically we do vertical spreads, short verticals. Typically, we're doing them out of the money because with these spreads, with these verticals, really it kind of depends for a lot of these Greeks as to where the stock is in relationship to the strike price. Okay? So a short put vertical is a bullish trade. A long call vertical is a bullish trade. A short put vertical, theta is positive if it's out of the money. Time decay helps you on that if you're out of the money. The short put vertical is like the short put in that regard. But the Greeks are going to be kind of muted a little bit, kind of lesser. And the reason is it's not just a short put. It's a short put and a long put. So they partially offset each other. Okay? So the theta is going to be lesser on the short put vertical than the short put probably, but that's how that is. Vega, same deal. Here's your vega is negative if it's out of the money. Short call verticals, bearish trades. Theta, positive. Vega, negative. Okay. Long call verticals, bullish. Long put verticals, bearish. What about your theta and your vega? You know what? It gets more murky with these because it depends what strikes you pick. So I don't know how to designate that, but it could go either way. I'm just going to put a 0 here on this. Theta is not clearly positive or negative on a long call put vertical or a long call vertical. It just depends on what strikes you pick. Okay. And so there we go. Just keep that in mind. Now, what about these trades? These are all more neutralish trades that you're maybe familiar with. Calendar spreads, butterfly spreads, condor spreads. So by neutral, I'm going to put a 0 here and just say that's neutral. Okay. Are they always neutral? No, it kind of depends on the strikes you pick, but that's usually the intention is relatively neutral. If you pick a calendar spread that's a little bit higher than the current stock price, well, it's a bullish calendar at that point. If you pick a calendar spread that's lower than the current stock price, it's a bearish calendar. Butterfly spread, if the middle strike is above the current stock price, it's a bullish butterfly. But in general, we're going to try and keep these as more neutralish type trades. All right. Now, one reason we do neutral trades is because time decay works for us on these. So positive theta on that, okay? positive theta on butterflies, positive theta on iron condors. That's nice. And here's where the theta vega being opposite thing doesn't always work out. On calendar spreads, implied volatilities work, are implied, vega is positive. On butterfly spreads, vega is negative. And on iron condors, vega is negative. Okay, so that's all I'm going to do here on this right now. However, let's kind of just consider a couple other, because when you are looking at an options portfolio and you're looking at more complex type trades, you just got to kind of add up the pieces. So in other words, let's say we're talking about a long straddle, okay? A long straddle. So what's the characteristics of a long straddle? A long straddle is simply a long call and a long put. So my delta, well, positive and negative. If it goes up a lot or down a lot, we're in great shape on that. If it kind of stays neutral, that's not good. Because time decay, add up the two, long call and long put, two negative thetas means this is a negative theta trade. We know that, okay? Two positive vegas means it's a very positive vega trade. So you can construct your options trades, whatever they are, built on these building blocks, okay? Let's think about a covered call. What's a covered call? Well, a covered call is long stock. Well, I didn't put long stock on here, but a long stock has 100 delta for 100 shares. It also has a short call element to it when you have a covered call. So it's going to take on the Greeks positive theta because there's no theta on long stock. And negative vega, there's your covered call. It's built from these components. And let's just talk about one more maybe. How about a collar? Okay, we'll just do a collar here. Okay, so what's a collar? A collar is long stock. It's a short call and a long put. Okay, so there's your collar. Well, what are the elements? Long stock is positive delta. We'll say 100 for our example on our delta. It doesn't have any theta or vega. Okay. Short call, assuming we do it out of the money, and I'm just going to make up a strike here. We're going to say the short call is maybe a negative 30 delta. Theta, it's going to be positive theta. Time decay works in your favor. Vega, it's going to be negative vega. Long put, again, it depends on the strike you pick on it, but if we do that out of the money, we'll say it's like a negative 30 vega if we do it out of the money. Theta is negative 30 delta if we do it out of the money. Theta is negative and vega is positive. These kind of offset each other, okay? To a large extent, it's probably not going to be exactly zero. But so when we pull up an individual trade and you think about the components, that's how you come up with it. And it's probably going to end up being net positive delta, a little bit at least, typically, okay? So that's that. That's all I wanted to mention on that. But let's consider a trade and see how it affects things. So let's do this. Let's go and let's look at a particular trade. I've got FDX here. We got FedEx in our portfolio right now. How is this, if we take this trade out, how is it going to affect the portfolio? FedEx is, what is it? I've only got 2 days to go on this. So usually on these type of trades, we're going to get out there. With a couple days to go, but we have a long call, same strike, same expiration, long put, same strike, same expiration, and it is a, so that's a long straddle, all right? Here's a long straddle. And so how's this going to affect the trade? Well, we got to look at it individually. When we started with the long straddle, Our long call and long put probably each had about a 50 delta. What's the delta now on it? The call has a delta around 95. The put has a delta around 10. Okay. The deltas changed over time. The thetas change over time. Vega changes over time. But if I remove this, if I just get out of this trade out of my portfolio, I'm removing about positive 90 deltas. Now, these aren't beta weighted deltas, but I'm removing significant positive delta from my portfolio right now. So consider not just the individual trade and how you manage the individual trade, but consider how that affects your overall portfolio's delta. How's it going to affect my theta? Well, I'm removing some negative theta here on this, okay? So I have negative theta, around 100 negative theta on that. That's a fair amount of money, okay? That's like $100 a day on this that I'm losing. It's not a realized loss because there's a lot of different factors in there, but just if we just focus on the time component, that's significant. It's going to help my theta profile if we consider a positive theta as a better than negative theta. And then your Vega as well. These change. This is going to affect our, we're going to remove a little bit of positive Vega on the trade there. Okay. All right. So I'm going to, in the name of money management here, there's only 2 days to go on this. I'm going to look to get out of this trade. Unless you're intentionally holding on an option all the way to expiration, we're probably going to get out before expiration. That's going to be kind of the default status. We'll look at a couple today where we're not necessarily going to get out, but typically that's how we're going to do it. This is not subject to early assignment. Why? Because we have long options here. Short options are subject to early assignment. Long options aren't, but we're still going to get out there. So this is what we're going to do. We're going to close out of this trade. I'm going to get out, and I can get out of them both at the same time, or I can get them out one at a time. I'm going to right click on it. I'm going to create the closing order. I'm going to get out of this, and I'm just going to confirm and send that. And we're going to get out of this one. We're going to create a closing order. We're going to get it. We're going to get out of this one, send, and it's thinking. Okay. So this doesn't have much in the way of value on this. Well, it still has 95 cents. Why is this not filling? One sec here. Let me just pull up my trade here. We've got a working order. Let me cancel and replace this. I think it's that spread on it, which is getting us. It's not filling, but that's okay. Hopefully, maybe FedEx will take a big drop in the next day or something like that. That would benefit this trade. Otherwise, it's far enough out of the money. It's unlikely to be worth anything. If it's worth something at expiration, great. If not, that's okay. Okay. So that's how moving the one trade can affect our Greeks. So therefore, now let me just check the chat. And a reminder, Kevin posted, we have a survey link in the chat. We do appreciate your feedback, everybody. It's a short survey, and it benefits us. Helps, you can put in topic ideas, and often I'll incorporate those in the future webcasts as well. And so we do appreciate that. So, and Kevin, thank you for your help on the chat there. Let's see. I have a request on thinkers. Can we pick different date for put and call in the caller with stock? Okay. So Prakash says, if you're doing a caller, can you pick a different date on the call and the put? You can. I mean, here's the thing. going back to what we were saying before, you have these components, these four components of your trade. You can create whatever trade you want with this. It doesn't matter what you name it. It still may be a valid trade. Is it technically a caller in that case? I don't know if you'd still consider it a caller if you have different expiration dates on your call and your put on the caller. Does it matter what we call it? I don't think it matters what we call it. It's effectively doing the same thing there. So, hopefully that helps. Now, some of these trades are very straightforward. Okay, some of these are very straightforward. Oh, Prakash, can you do it? You can add any trades you want in here. Okay, if I have long FedEx and I want to add in a short call, I can click on the short call. I can add in a long put. Okay. I can do that. There we go. Different expiration dates. It's all in one place. Okay. It doesn't technically call it a caller. Does it matter? That's how you do it. You can always add in these different trades there. Okay. You can do it just like I did. Make sure you hold down the control key. Okay. Just make sure you hold down the control key while you do it. And that way it will add both in and not just one at a time. Okay. But yes, absolutely, you can do that. All right. Let's move forward. Let's look at some of these other trades here. So I'm going to start with one that is a little bit more of a messy trade. Okay, it's a little bit more of a messy trade. And then we'll have some that are maybe a little less messy. But I want to go to this long single options category I have. Now, I put a note in this just to help remind myself because I deal with a lot of trades here. And so I encourage you to use notes if you want. Click on the note. I just have PMCC. That means poor man's covered call. That's just a reminder to myself of what this trade is. Technically, this is a diagonal spread. Okay, technically, it's a diagonal spread. And we're about to expire we're getting near expiration on this. So we definitely want to manage this one. Remember, short options could be assigned early. But how do we manage this? Right now, we're actually down on both. What happened is we got in Schlumberger, okay, and it went down. Okay, so we were showing a big loss on this, bigger than what it is now. And the initial short call we had on it, we bought back, and that was great. But we actually lost more on this than we made on that short call originally. We then sold another call. Schlumberger subsequently has gone up. This number, so this has actually gotten better. It was actually worse than 307 before. But since Schlumberger has gone up, we're actually losing money on this one too. But here's the point. We can't stay in this one anymore. So we have some choices. We can get out of the whole thing. And we would do that probably if we were just bearish on the trade. This is a bullish net trade typically, okay? Right now, so typically on this, your delta is going to be higher on the in the money call than the higher priced, the more in the money call at least, than the higher priced short call. In this case, it still is, but it's actually relatively close. But this is generally a bullish trade. And the reason this is close is because we're near expiration. Deltas, as you get closer to expiration, move. Okay? They move. So, for example, let me go back to, we're looking at SLB here. Okay? Here's Schlumberger. If I look at let me just go and we'll just do a few strikes. We'll look at the 5250 strike. Okay. Oh, maybe there's not a 50. Yeah, there's 52.50. What's our delta on this? It's about 60, 30 days till expiration. If we go to the 52.50 for 2 days to expiration, it's 76. As you get closer to expiration, deltas tend to move up towards 100 or down towards 0, depending on if they're in the money. If the delta is above 50, it's going to tend to gravitate more up towards the 100 level. If it's out of the money, below 50, it's going to tend to go closer to the 0 level. That's what we're experiencing on Schlumberger right now. So therefore, when we look at this, our deltas are actually pretty similar to one of these each other, okay? But typically on this poor man's cover call, my delta is going to be significantly lower on this, so it is definitely going to be more of a bullish trade on this. But we're going to have to roll this out. So I'm going to roll this out a little bit, and let's just look. I'm going to go here, and I'm going to go to, let's go out. I'm just going to go out to like 23 days here on this. And I'm going to go out of the money on this a little bit. And we'll go to about a 28 delta. Okay, so delta tells us how much the option is going to move in relationship to a $1 move in the stock price, but also gives us an idea of how far out of the money it is. So, or also a way of saying, what's the probability of this being in the money? Well, we're going to keep this kind of lower probability. We're going to make this out of the money. Stock's at 53 and change. This would be 56. I want to sell the 56 September 11th. Okay. So what I'm going to do here is I'm going to do this, and I'm going to roll this. I'm going to right click and create a rolling order. Now, Greg says, let's just get out of the other one. Okay. Let's just get out of the short call and just let the long call do its thing because Schlumberger is trending up. I have no problems with that. If you are bullish, then that is absolutely a valid way of approaching this trade. As long as you're bullish on Schlumberger, and the trend is going up, I will admit that right now, the trend is going up. But I want to keep this as an example trade of poor man's cover call and management on this. So therefore, I'm going to actually roll this one out. But I think that Greg has a good point on that. If you're just bullish on this, don't roll it out. So we're going to go to June. We're going to buy that back. We're going to go to September 11th, and we said the 56. 56. That's going to bring in a little credit here on this. I think. Oh, okay. Hold on one sec. Let's just take a look at this because this went in the money. Let's just see what we got here. 56, we're selling it for 66 cents. The current one we're in, it's actually not a credit. It's actually going to give us a debit in this case to roll this trade out. So some traders will say, and this is why I said this is kind of a messy trade right here. This is the most complicated one that we're going to deal with today, I think. Some traders will say, look, I'm not going to roll for the debit. I'm not going to roll if it's going to cost me more to stay in that trade. I'm just going to let it sit here on this as is. But I want to keep this example in for this trade as a poor man's covered call to manage in the future. So I'm going to actually enter that trade in. It's thinking. We'll see if that fills here, and we'll let that do its thing here. Okay. So there we go. We just filled. We just rolled that out. And there we go. Let's look at some other trades here. Okay. Okay. Let's go right here. This is our long single options. Let's go to short verticals. Okay. Let's go to short verticals. Let's do this. This is a different strategy, and I have a little note on this. Wheel strategy, okay? So just as a reminder, oh, by the way, for those of you who are interested, if you're interested in the initial session where we did the poor man's cover call, I did that in the advanced options webcast, not this webcast. Here's a link for that webcast I'm putting in the chat. Well, actually, it's not the specific webcast. It's for the playlist for that class. And it's June 5th, if you're interested. And if you're watching on a recording and you're not seeing the chat, it's in the description. The playlist is in the description. But the specific webcast, you got to go back a couple months. June 5th, you'll see that webcast there. Okay, now here's the wheel strategy. What's the wheel strategy? Wheel strategy is this. We sell a put, okay? And if the stock stays, if this put expires worthless, we just keep the premium and we're great. We can sell another put if we want. If the stock goes in the money or we get assigned on it and the short put goes to stock, okay, then what we're going to do is we're going to sell a covered call on it, okay? We're going to do a short call on that. And then if the stock doesn't get assigned, we'll probably sell another call on the next month on that. If the stock does get assigned, then we'll lose a stock and we'll sell another put on that. And that way we're able to bring in a premium and keep in bringing premiums in. That's what the wheel strategy is. Okay. So AVGO, Broadcom, we have a wheel strategy. We're 2 days to go to expiration. So normally, remember I told you before, normally when we're a couple days to go to expiration on most of these option trades, we're not going to let it go to expiration. One reason is we risk early assignment. We would welcome early assignment in this case. That would be no problem at all. We'd own the stock and then we could sell a covered call. Right now, what the price is saying is this. We sold it for basically $1,100. Right now, it's worth about $500, which is great. It's gone down, but it's still close enough. The stock price and the strike price are still close enough that that there's still uncertainty, which is why that option still has value on that. So we're going to let this sit. Normally on these type trades, we're getting out at this point, but we're fine buying the stock. If you're fine buying the stock, you can let that short put run on that, and then we'll look to manage that further. Now let's look at CCL. CCL is another wheel strategy, okay? CCL is another wheel strategy. And so let's do this. This is 2 days to go to expiration, all right? Notice the mark price. It's almost worthless at this point. It is almost worthless at this point. So here we go. We sold it for $54 right now, not worth much. We can let this just go to expiration, and in all likelihood, unless we see a big change in the stock price, this is just going to expire worthless, and then we can sell another put. If we want, because we've made most of what we can make on this, we can roll this out at this point, and we can go out about a month is typically how we're doing it, and sell another put on this. So let's look here at CCL and look to sell another put. I'm going to go out another month. I'm going to go here and I'm going to go, well, you know, I can do whatever strike I want. And I can go to the 26th strike for September 18th. I'm going to look to get out of this one, create a closing order, buy this back, and confirm and send. And I'm going to send that. And it's not filling right now just because it's almost worthless. That's okay. That's not a problem. If you have the buying power, you can always add in the other trade now. But keep in mind, if I add in another short put, I'm now obligating myself to buy another 100 shares of stock. Okay? And maybe that's okay. Maybe that's not. But it's up to you and how much, whether you're able to and whether it's wise to take on the additional risk there. But I'm going to add that in the same bucket there. And it basically it's just going to roll that out in a sense there. Okay. All right. Now, question in the chat. We just talked about short puts, talked about covered calls. Question, what's the number of stocks you should have when doing covered calls? You need 100 shares to do a covered call. Okay. So if you have 100 shares, you can sell a contract. If you have 200 shares, you can sell 2 contracts. If you have less than 100 shares, you can't do it. You may be able to sell a call if you have the options approval level, but technically that's a naked call. And that brings on additional risk. Theoretically, unlimited risk. So 100 shares for a covered call or multiple. You can do more contracts if you have some multiple of 100 shares on that. Okay, let's look at another trade. We talked about Broadcom. We talked about CCL, Carvana. Okay, let's look at Carvana. Let's see what we got here. Do you see, what do we got here? We got a short put, and then we have a short call vertical spread. Short put, short call vertical. And this may not be something you've heard of before, but when you put those together, it's a jade lizard, okay? It's a jade lizard, okay? So whether you know it as a jade lizard or not, it doesn't matter. It really doesn't matter. Because remember, when you're looking at your options, you have your 4 building blocks for your options. In this case, we're doing a short put. We're going to be doing a long call and a long put as well. It's a jade lizard. So I was trading these before I ever knew that's what somebody called it there. And so here we go. We did an example of this in this webcast in the past. But regardless, whether we're doing iron condors or short put verticals, short call verticals, or short puts, remember to have your exit points in mind. What if it's going well? What if it's going poorly? What if we're getting near expiration? We're near expiration. So except in the case where we're explicitly holding it to expiration, 2 days to go to expiration, we're going to get out of this. Okay, we're going to get out of this trade. 2 days to go to expiration. So, and really about a week or so to go to expiration, usually we're going to look to manage this trade. So we may have managed this last week, but I was out of town last week in this webcast. Thanks to Barb for covering for me on that. But what I'm going to do is I'm going to get out of the put and then I'm going to get out of the call spread. I'm probably not going to try and get out of all 3 at once. Because when you're trying to get out of all 3 at once, you're asking the market maker to fill all 3, which means you're probably less likely to get as beneficial of pricing on those. It just depends. I don't know for sure. It just, on the circumstance. But generally, I'm just going to get out of this short put. I'm going to buy it back. Okay, we're out of the short put. And we're just taking our profit on this. This trade actually worked out fairly well. And then I'll get out of the call spread itself together. That probably works okay. That may or may not. Again, it's almost worthless. That's probably not going to fill there. Let's just look at this. There's hardly any value in this call spread right now. So buying it back, really, it may be something where we just let it expire. A couple days, it's going to go out of the portfolio, barring the stock goes way up. The stock right now is about $70. Our short call is 82. Theoretically, this short call could be assigned early. Practically, it's very unlikely unless we get a very strong move up on Carvana. Strong moves up happen though. You know what? We saw that today in Moderna. Now, to be very honest, biotechs tend to be more susceptible to these massive moves up, but it's still a pretty rare occurrence. But it could happen to any stock. Okay. All right, let's look at Nike. I've got Nike. It's an iron condor. I have a short put vertical. I have a short call vertical. Altogether makes an iron condor. 2 days to go on each. Generally, when you're managing iron condors, manage the put side, manage the call side separately. But in this case, and so if the put side is near a max gain, or maybe we've made 80% of what we can make on that put side, we're just going to exit out of the put side, and maybe we'll leave on the call side. And vice versa. If we've made 80% of what we can make on the call side, we'll just exit the put side. But regardless, if we're less than a week to expiration, we're looking to get out of these. So I'm going to look to get out of both of those trades here. And let me clear my drawings. Let me get out of that. And you can just get out this way, create a closing order. We're going to sell that out and confirm and send. And we're going to send that. And it's not filling because they're almost worthless. If these start to get, if the stock starts to move closer to our strikes and they start to threaten a little bit, then these trades will likely fill at that point. But meanwhile, it's on track to probably expire worthless. So we're going to let that go. Now, I'm getting low on time. Let's do one more. I've got PayPal. Here's a short put on PayPal. My management on this is going to be similar to some of the things I've said before. Unlike the wheel strategy where we're willing to get called out, that wasn't our goal on this. So when we get to about a week to go till expiration, we're probably going to just look to get out of this. We still have 30 days. Is it going well? It's going well. So we'd say if there's a technical breakdown in it. In other words, if we're bullish on PayPal and PayPal is just dropping, breaking support levels, we're probably going to say, I'm no longer bullish on this. I want to get out of this. But in this case, when we look at PayPal, it's cooperating. It's still bullish. So if things are going well, how am I going to manage it? Assuming we're more than a week to go till expiration or so. Well, I'm going to look and see if I've made most of what I can make. In this class, typically we'll say 80%. Have I made 80% of what I can make on this? Originally, I sold this for 123. 80% would mean it's worth about 24 cents. Okay? I just basically doubled this to say it's going to be worth, if it's 24 cents, it's worth 20% less. 20% is left of the value of that contract, or we've made 80%. In this case, it's worth a little bit more than that. We're going to let another week's worth of time decay. We do have positive theta on this trade. Work its magic, so to speak, hopefully. Now, there's a danger in holding on to that. PayPal could completely fall on us in that time, but we're going to hold out till the rule that we've used in this class is fulfilled, okay? And that is 80%. Now, I don't have time to actually go through the trades, but I just want to look at a couple others here real quick. I have another trade on Broadcom, AVGO, and this is a calendar, okay? I need to roll it. I only have 2 days to go on this trade. We got to get out of that trade, okay? Uber. So after class, I'm going to look to either roll this or just close out of the whole thing. Actually, I have an inkling on this. I looked before. And let me just show you this. If I roll this out to a date where I was looking at, I think I was looking at like the September 2nd contracts, there was an issue. And the issue is this. The spreads are terrible. You see, yeah. Do you see that? The spreads are terrible. So practically, I would not roll this. I'm just going to close out of the whole thing. If you can't get halfway decent spreads, don't even continue with the trade. Get out of the one that you're in that you can get out for, get out while you can, I guess is the point on that trade there. Okay. So this one, we're going to end up eating about 120 bucks out of that trade. We lost that. We'll get out of that. Everybody, I'm out of time. I appreciate you joining me. I really do appreciate you joining me. So thank you very much. Coming up next, we've got trading price patterns. Thank you, Kevin, for helping me on the chat. Everyone, we'll be back same week, same time next week for a new webcast here on this. Have a wonderful rest of your day. Bye-bye, everybody.